pay attention to the money. The money is really important. Make sure you're conservative with the money. Make sure you're investing it well. Because if you don't invest it, it doesn't do you. You put it in a mattress, it loses so much value. It's got to be invested. But if you invest it too aggressively and the risk reward gives you a little more risk than reward, then maybe that's not so good. So you've got to balance, you've got to diversify. But follow the money, get the money. When you think about a startup, the thing that will kill a startup faster than anything else is not being able to generate revenue.
Welcome to the latest episode of the Raise&Exit podcast. Today we have Steve Valentor from Polynomial VC, which is just the beginning, or is it the current story of Steve? Steve, it's a pleasure to have you here. I'm very excited to interview you from a number of perspectives, both because of the fact that you have been running through engineering-driven industries, that you've been running through areas where technology and IP and valuation come slowly and then suddenly, and then you've shifted over to the venture side, but not just a generic venture side. I have some questions. So on that note, I'm going to hand it over to you to maybe add to the introduction. So Steve, please introduce a bit further beyond my own intro to you.
Well, Edgar, thanks a lot for having me. It's a pleasure to be here. Your work is remarkable, and I'm thrilled to be able to participate. So my background is all tech. I grew up in the personal computer industry before it existed. Back when I went to college, we didn't have personal computers. To get to computers, we had to carry decks of cards to mainframes on campus and run them through, and then wait for your printout much later, and then go and get a copy of that, which was a big stack of paper. So being part of that tremendous growth, the company I worked for grew from 75 million to 1.5 billion over a 6-year period. So 200-fold. Tremendous learning opportunity. And since then, I moved from computers to semiconductors, got involved in aerospace electronics, a little software thrown in. And then the last 6 or so years, I've been involved in venture capital, actually investing in these type of early stage technology companies. And I use this polynomial process, which I think is what we probably want to talk about a little bit today.
Yes, and I'm still going to ask you one more question before we get into that side, because there's an element that is there in the work that we try and focus on at Raise&Exit, which is the notion of, what does it take to go and raise, what it takes to sell, and then what do you have to go and consider in terms of how the other side is looking at investing or acquiring into you. So before I jump into, and maybe it's the bridge to the polynomial side, but I would like to kind of get a reflection from you. What had you go and start a fund and start making these investments 6 years ago? And what is one or two things that maybe one thing that has been reinforced 6 years later, and one thing that you're like, wow, I really just misunderstood this aspect of investing.
Yeah. Okay. So the story of how I made the transition from technology to investing, I'll go through that. The second question, I should have wrote myself a little note. What was the second question, Edgar?
The second one was, what was it that you, in hindsight, you're like, wow, I'm throwing out this hypothesis from 6 years ago about being a venture investor.
Yes, exactly. And where I surprised myself, what I learned that I didn't realize is really how difficult raising money is. How difficult it is to, no matter how creative or differentiated your thesis is, it's just really, really difficult, especially coming from the technology side. I think a lot of people who go try to put a fund together do it from working at another fund. They find some limited partner investor that takes an interest in them. They offer something a little different. That's their seed, and they get started, and then they can attract other investors that way. When you're coming at it from my perspective, which I was the leader of technology companies, and I didn't have that database of connections in the LP market. So I'm coming at this new and trying to communicate the value proposition, and it's just really, really tough. Now, there is no good or bad time to start a business. Some of the greatest businesses in the world were started during some of the worst economic periods, and vice versa as well. So there is no good or great time. Though the particular subset of the limited partner market that I've gone after has been in a particularly challenging environment over the last few years, and this is primarily the university endowments. But the thing that got me making this transition, by the way, it's not like I spent my entire career in giant multinational companies, just about half. So I worked at every level, from entry level engineer up to the VP level or senior VP level in multinational companies, giant, multi-billion-dollar worldwide. But I also have been involved in 6 startups, and some of them like a laptop computer startup back in the late 80s when they didn't exist at all. So I've always had this entrepreneurial spirit.
Is there a cameo?
No. That's a pretty good idea, though. We should look into that. But the thing that moved me from managing. So I had worked my way up from entry level engineer through manager, director, vice president, and then for 10 years I was CEO of an aerospace electronics company in Chicago here, Right Hand Technologies. I'm still involved with that company as a shareholder and a board member, but not in day-to-day operations. There was a tremendous consolidation that was going on in the aerospace business between 2015 and 2017, 2018. Just a tremendous amount of companies being bought by others. In our customer base alone, our biggest customer, Rockwell Collins, bought our second biggest customer, BE Aerospace. They had bought our third biggest customer, MTech. And the biggest deal in that space was Berkshire Hathaway bought this company called Precision Cast Parts, Portland-based company. They do about $10 billion. Yeah, they do about $10 billion in annual revenue, at least at the time.
That.
$1.5 billion in profit. But Warren Buffett, notoriously cheap investor, bought that company for $37 billion in cash. So he said, I've got $37 billion. I'm willing to buy a thing that's only going to give me about a $1.5 billion return, which is a very, very small percentage. That's a very high multiple of earnings, abnormally high. And I looked at that and said, look at this market. All of these deals are being done at this really high multiples. We should take our little company and go out and sell it. And so I hired some investment bankers, and the most we saw was offers that were much, much smaller than that, where these deals were being done at 15 and 20 and 25 times earnings. Here, we could find, people who were willing to offer us 6 or 7 times our earnings. And we say, for what we've got invested, we're better off not selling. We're better off just operating the company. So I was really perplexed by this. And, people said, well, you're a small company, Steve. You're not going to get those kind of multiples. And I said, well, does that make any sense? If I have $1 to invest, I'm going to get some return on the dollar. If I have $10 to invest, I'm going to get a little more. Well, maybe if I had $1 million to invest, then I could maybe get into some, hedge fund or something like this, and maybe I'd get a better return. But investing in, dollar for dollar, investing in the same kind of thing, you wouldn't expect much of a difference. So I started looking into this, and the answer is not nearly as simple as big companies trade at higher multiples than small companies. What really is the case is big companies have very efficient infrastructures, and they have taken into account every contingency and they're organized kind of like a military. They're designed so that they can keep running no matter what kind of perturbations happen to the market or to their personnel. They could lose people, and it's just irrelevant because the processes just keep moving along. In small companies, that's not the case. If you look at a small company and you say, how do you do your accounting? If a big company is going to use Oracle or SAP almost for sure. You go to a small company and they say, we use QuickBooks. Well, what the investor hears is, you use spreadsheets. You have no ERP system whatsoever. What about human resources? And they would say, well, Sue is really good with people, so she takes care of that for us. And you say, you have no HR infrastructure. You have no plan for replacing your people. You had no protections. So you've probably made a bunch of errors. You could have liabilities out there that you're unaware of. So when you look at all these things, then you have to say, no, I really need to look at all of the aspects of my business. Well, how do you do that? When you look at you go to a public company, and you go to Yahoo Finance, which is, I think, the best in terms of delivering the financial statements of publicly traded companies. You go there, and you take a look at these, and they give you, your revenue, your cost of goods, your expenses, and you can look at your balance sheet and your cash flow. But it doesn't give you too much information. Well, when you really look at all of and they give you a few ratios. They give you the price to earnings ratio. They may give you like return on investment or return on equity. But if you look at those numbers from an accounting perspective, what you find is there are 50 ratios, maybe even more than 50. And they're just all kinds of ratios that accountants create. And they are all created out of those primary financial statements, the ones the SEC requires. So when you look at them at the top level, you don't see this. But if you take them and you start to, well, what is a ratio? A numerator and a denominator. And if you can disaggregate that numerator into a number of components, like instead of revenue, you'd have, sales times, unit price of the things you're selling. And if you wanted to look at sales for some reason, you could say, well, let me find something in a denominator in one of those ratios that has sales in it. Let me see what other stuff I can cancel out so that I can surface that information about sales and just take a look at it. Now I can analyze from just the public financial statements. On one side, I can analyze the publicly traded company, who might be a prospective acquirer, or it might represent the industry that I'm playing in. On the other side, I can take a look at my portfolio company. And when I do that on a term-by-term basis, I can combine the like terms, if you remember polynomial math, combine the like terms, and now you can really start to see the differences between those. And what you find when you do this analysis is all of these deficiencies surface themselves. They become readily apparent. And so now you have a way to take an industry average, an industry representative, or a prospective acquirer where you have public statements, and your portfolio company where you have all the financial statements. You can identify your deficiencies. You have a way to create objectives for your management team and say, over the next 3 to 5 years, let's take our performance in this area and the industry standard performance, bring them into convergence. And now you've got a valuation that you can defend against, as really accretive in every measure, if it's an acquisition, or representative of the industry standard if you're trying to do something like an IPO. And so that was the level of analysis that I came up with. And I said, this is really something that I don't see too many people doing. It does happen in the analysis departments of every private equity firm and venture capital firm, but do they really take it into consideration at the same level that I'm going to in this space of early stage technology companies? Because that's all I've known, that's all I've done for 40 years is early stage technology companies and in these new emerging markets. So anyway, that's the story of the polynomial.
I think that was, to me, one of the fascinating aspects of just getting into the conversations of having you as a guest on this show, because I think that there's this predominant obsession that we have in terms of where the light is shining, right? And we are missing kind of like those value drivers that is there. Like your point about the fact of I look at it this way: be careful on what you're going as a reference for your valuation. People go and talk about market multiples. One of the ones that drives me crazy is when people go and say, well, X company got bought for 37 times revenues. I'm like, that's great. That is 1 out of 3 million companies in that sector globally. Let's talk about the other 2.9999 million. And I think what you're pointing to there is that where are you and what are you doing about you being at a discount to what is giving a premium valuation in the category. And I think it's hard for business owners and founders to be looking at that on a regular basis. I actually think we have a lack of modeling in that domain, because we got to keep in mind, you only have time to do so many things. Founders and businesses are in the business of serving their customers. They're not in they're not in the business of selling their business. They're not in the business of, analyzing their own business to death, et cetera, beyond what, makes a better than a typical decision. So I like that aspect of what you're going to bring in here. So what would you say for people listening to this is kind of called like minimum necessary elevation above the mean? Right? So if you're just trying to be smarter, just slightly smarter than the average bear, as a founder in setting yourself up for a responsible conversation in the future? What are some things that you'd recommend for them to look at, whether as ratios, as frameworks, or points of reference in their industry?
Well, that's a great question, Edgar. And what I would say is you have to when you start off, you have to have a great idea. You've got to have a market that you know is growing, is going to be able to support the business that you're trying to build. You've got to know who the competition is and all of that sort of stuff. You want to look at what is your long-term strategy. Do you want to create a great company that you're going to work for forever? Is it your retirement plan? Is it your family business that you're going to try to hand down? And these are the kind of things that will really set you in a direction. Do you need to bring in outside capital? You know, do you want to build a business that's going to grow much more slowly, but you're going to be able to retain control of it? If you are looking for very fast growth and you need capital that you don't have, you're going to have to bring in partners. Well, the reality is, as soon as you bring in partners, you no longer are in control of your business, really. Even if they're minority partners, you're still, even if you have these crazy arrangements like Uber had where the CEO got 100 times the vote or whatever it was for his shares, you still don't have control of the company. They forced him out, obviously, eventually, so he was unable to use that as controlling leverage. But the overall trajectory is an interesting thing to study. You know, when you look at new startups, they're almost always formed by one of two class of genius. They're either a technical genius who says, I've got a new product or service, I'm going to change the world, and I'm going to succeed. Or they're a sort of sales genius, and they say, give me a great idea, and I can sell it to anybody. And in either case, they focus on the thing that they're making and the customer that's buying it, as they should. And so they have this very, very narrow focus of what they're building and who they're selling it to. And all of these other areas, rightly so, are put to the back burner. So Sue is good with people, so she's going to look after HR. So all of this is good. But as you start to mature and as you start to get to, if your objective is to have a point of exit, then you have to say, how can I defend my valuation? How can I defend my valuation, whatever I want to get for my company? And to do that, you've got to have empirical data. You've got to be able to say, oh, look, these other companies traded at these, and you mentioned these multiples. The funny ones, I've heard several of them over the years. One of them is multiple of number of employees. So we can increase the value of people believe they can increase the value of the company by having more employees. It's like, oh, okay, so I just got to hire a bunch of extra people, whether I can afford them or not, my value goes up. Well, that's obviously not true. Another one is multiples of revenue. Well, you could have a company that's losing money. Does that mean it's valuable? I don't know. It certainly was the case with Amazon. They lost money for how long? And Uber lost money for how long? You know, I don't know that those companies ever get to the point where they can really pay back their investors, or at least generate free cash flow that can issue distributions or pay dividends to shareholders that are going to compensate them for the amount of risk they took and the amount of money that they've had to pay in terms of the market cap of those companies. So it's a really interesting thing. But I would say to the entrepreneur, what do you want to do with the company? Is it something that you want to grow and sell? If it is, then you really need to look at all these ratios. You need to say, how am I going to find a way to appeal in the period of time that I'm looking at? How am I going to find a way to appeal to my prospective buyers? Who are they going to be, and what are they going to be looking for in my company? And if you do that from the very outset, you'll build a much different company than if you just play whack-a-mole trying to get, you know, the best deal for every customer. As you have to do that too, but if you don't have a long-term plan, it's going to be really difficult to enter into any kind of a transaction, a meaningful transaction that's going to benefit you. At least you increase the probability by taking all of these steps.
I think you're just unpacking so many critical questions that I think organizations just generally need to be looking at, regardless of whether they are an early stage company looking to raise, or maybe, you know, late in your ownership stage and you're trying to sell and keep the business and the employee success going under new ownership. I want to unpack something that I think you went and said there, which I think is very, very critical, which is, I think are you letting market narrative define your valuation and you're just taking it as gospel, right? Oh, I'm in fintech, we're 3.7 times revenue, 18 times EBITDA, whatever the heck it is. Or I think is what you're going and pointing to, what can I fundamentally defend from an empirical standpoint? What, as an early stage company, what's that moment of maturity that it becomes a responsible act versus a frivolous theory crafting exercise?
Well, before you even get to that point, this critical, you touched on it, you just touched on it in the description of the question, which is market fit and traction. So before anything else, you have to be able to demonstrate that people want to buy what it is that you're selling and that you can create it and deliver it at a profit. And that's the first thing. And that applies to every single business. And whether your goal is to own the business forever, make it a family business, make it an heirloom, or grow it very quickly and try to appeal to the investor market, either strategic acquirer, private equity, or even an IPO, you've got to decide at some point in your journey, you've got to decide what it is that you want to do. And I would say that that's the most important thing. Is to decide what you want to do and then find market fit, and then make sure that you can deliver it profitably, and then you have a chance at this. Now, after that, then you have to start looking at it. If your goal is to sell the company, whether it's any of those three that I mentioned or even some other more private sale type of thing. Warren Buffett again says this better than anybody else. What is the real value of a company? He said, well, you take all of its future earnings and you reduce those back to today's dollars, and that's what the present value of the company is, no more, no less. And I would say to every entrepreneur, that's what you want to be looking at. You want to say, well, how is it that I'm going to evaluate that? And there's a lot of different ways. Like we said, sometimes some people will look at multiple of employees or revenues. Really, earnings is important, but even earnings doesn't tell the whole story, because these typical multiples that companies are trading at don't line up at all with that analysis of the free cash flow. There's this pretty funny video going around. They have two pictures. Both are two pictures with long blonde hair, and the one is like a supermodel, and the other one I think is Iggy Pop. And under the supermodel it says EBITDA, and under the Iggy Pop one, who's a little wrinkled, a little worn out, but he's got the same hair, and that one says free cash flow. So ultimately what an investor is looking for is, well, I'm putting my money up. I want a return on my money. I want a risk-adjusted return on my money. I want to know how much extra I'm going to get for the extra risk that I'm taking, and how long am I going to be invested in this. Now, there's a bunch of uncertainties in there, but every investor has to digest those uncertainties, and they have to make their decision. And every seller of assets has to try to appeal to exactly the right investor, or the one that's going to give them the best solution to whatever the journey that they set out upon, or the mission that they're trying to accomplish. So the sooner in your journey that you can decide how you want the journey to continue and end, the easier it will be to prepare for some kind of a transaction.
Oh man, there's just so much to unpack here. I'm like frantically capturing little notes of like, okay, here's a new nugget, here's a follow-up question that's there for you. I want to lean into one thing that kind of emerged in there, because I struggle with the notion, as I think you do, on these multiples of people, multiples of revenue, etc. that is there. Because I always look at it this way, like you're not trying to win the Olympic 100-meter dash where you have to be first, right? And I think that there's a certain like existential sustainability, and given your experience with companies that have gone to a 200x revenue growth in your time that you've been involved with them, I do feel that there's a disconnect, and I think it's a struggle for everybody involved, in how you value a company that is trying to fundamentally change the category dollars, right? More of the deep tech, more of the disruption. This is not a, we have a 10% better mousetrap. This is we are going to fundamentally change how this industry operates. How does one articulate that as a founder, where they may have, kind of call it, solution market fit, but maybe not yet revenue market fit, if you understand my drift?
I think I do, and it is a really interesting challenge. I gave a speech not too long ago. The topic was what industries and jobs are going to be at the greatest risk with the AI threat, or with the AI evolution, and it's pretty interesting. In the net, AI creates more jobs than it eliminates. And they say, okay, well, that's good. But what about the jobs that are eliminated? Well, if you just look through history, we don't have lamplighters anymore going around on horseback with torches lighting up the streetlights. We certainly don't.
Go and show Mary Poppins to young kids. Show Mary Poppins to young kids, and they are so confused.
Yeah, exactly. So jobs are always coming and going, and the technologies are always coming and going, and the way that things are bought and sold is changing on a continuous. It's a giant continuum, and anytime somebody comes up with a new product or service, a better idea, with something that could change the world, or at least change a little corner of it, they have to passionately embrace that, and then they have to try to be the one to change the world, to get people to understand the difference. And everybody's favorite example of everything is Uber. And you wouldn't even think of getting into, well, I guess we used to have hitchhiking when I was a kid. You could put your thumb out and you'd get a ride, and it was generally safe. There were a few stories but where things didn't turn out so well. But for the most part, and that used to be an adventure. We would go down to 111th Street in my neighborhood was the big street, and we just go hitchhiking and see who we could meet and where we could get taken to as kids. It was pretty amazing. But otherwise, setting aside the adventurous few, you wouldn't even think of getting into some stranger's car and asking them for a ride somewhere, and especially at a reasonable price. And Uber had to pioneer that. To do that, they really had to overcome a lot of legal challenges. What they were doing was not allowed in a lot of jurisdictions. Even San Francisco, where they kind of started, they had a big battle, and they had to change the world in their own little portion of the world. They had to change it to make that happen. And anytime you're trying to bring something new and different to the world, computers were going to eliminate office jobs altogether, and they didn't. Actually, they created a lot more office jobs, and there's just hundreds of examples of these industries that have just gone away. But as a founder, you have to believe that whatever it is that you're building can change the world, or at least some portion of the world, in a way that is going to benefit you and your customers and your suppliers and your investors. And it's been proven over and over and over again that works. So it's going to keep happening, and it's up to the visionaries, those creative few, those geniuses who say we can do better at this stuff, and just forging their own way. But it's a very, very difficult path.
Yeah, well, I think it goes into a lot of where we're going exploring regularly, which is the whole notion of time value or risk-adjusted time, and things like that. And I think that's a whole other conversation on its own. I want to bring this to one final question, which I think really your circumstances allows us to ask this, which is the fact that you've been in startups, you've been an investor, you've grown to large companies and been in large companies. As you kind of reflect on that expertise, what do you think is an underappreciated or even missed, it's not known anymore, of a fundamental practice that startups need? You're over your decades, over your 6 startups, what you're observing as an investor, what do you see as an underappreciated but critical component of building or running an early stage company?
Well, I would have to say that the single most important thing, and this is going way back into the 80s when I was in this laptop startup. I was in charge of the technology. My main partner was the marketing and sales guy, and we were pretty young, and we didn't think we could manage the company, or at least convince the investors that we could manage the company. So we brought in a president, but my focus was completely on the technology, and we built this. We did a number of innovations, and we built this unit that was really kind of innovative in its day. And we didn't succeed, and we tried, and we got a lot of attention. We had over 100 articles in the press written about us. I was on television. I was on CBS Morning News and FNN talking about these things. And we thought, oh, there's no way we can fail with this. Well, then we didn't succeed. We built the device, but we couldn't get it sold. We got passed by the industry leaders, even though we had an innovation. We were innovating not only the product and the technology, but the distribution method. In those days, computers were sold through two-step distribution, not direct to consumers like they are today. And so we were trying to pioneer that with the others in the industry, but bring real good technology to it. We didn't succeed. And in reflecting and going back, I tried to write notes to myself and said, what is it that I could have done differently? What should I have done differently? And what I kept coming back to is what is the most fundamental thing that every grandparent and parent tries to teach their children? Watch the money, save your money, be frugal. Don't spend on anything that you don't need to. Save for a rainy day. Keep track of the money because, and so that was the back in the 80s. My oldest kids were very small. My youngest kids weren't born yet, and over the course, now they're all grown, of course, but over the decades of raising them, I kept going back to that. Is you got to pay attention to the money. The money is really important. Make sure you're conservative with the money. Make sure you're investing it well. Because if you don't invest it, it doesn't do. If you put it in a mattress, it doesn't. It loses so much value. It's got to be invested. But if you invest it too aggressively and the risk reward gives you a little more risk than reward, then maybe that's not so good. So you've got to balance. You've got to diversify. But follow the money. Get the money. And that's when you think about a startup, the thing that will kill a startup faster than anything else is not being able to generate revenue, not being able to generate traction. You'll never get an investor if you can't demonstrate traction. So you've got to be able to demonstrate your product market fit, whether it's a product or service, by saying, oh, here's customers that are willing to pay me for this. I may not be profitable, but at least I've got cash flow. I can figure out a way to add efficiency that I can lower my cost and make sure that I deliver better value. But if I don't have anybody that's willing to buy the product and willing to put money into the top line of the company, nothing is going to happen in the middle and nothing's going to come out the bottom. So you have to have customers that are willing to give you money. And the way I've termed that over the decades and decades is just get the money. You don't steal the money. You offer a value proposition that people are willing to give you the money to get. And the one you have to focus on is not, even if you're in a business where there's resellers, like multiple steps of distribution, where you sell to, like a car manufacturer sells to a distribution center who then sells to a dealer who sells to the end user. The manufacturer, whoever's designing those things, had better be talking to those end users and saying, where do you want the buttons and what kind of colors do you like and what kind of performance are you looking for and what is important to you today? And you look at, people that do a great job of that. I have to, hats off to Elon Musk. The 2012 Model S was an enormous innovation in its time. It had so many new features and functions, and to say nothing of the electric. I mean, all the rest of it was just a fabulous design. And you look at that exact same design with virtually no changes 13 years later, 14 years later in terms of model years, and it hasn't changed at all, and it's still relevant and still current and still looks great.
It was a better vehicle that happened to be electric. And I think what you're pointing to is that people were saying it was an electric vehicle. And I think that is such a great summation of what you've been going and saying as well, Steve. Like it's
well, and the one extra point,
well.
Edgar. One additional point with that though is I think they did the best job of getting to know their customers. What do customers want? And over these years, they've still continued to remain focused on the customers, and that's why the Model Y became the best-selling car on the planet for quite a while. And if you have customers that are willing to pay you, then you can build any kind of a business.
Steve, this has been so good. I could keep this going, and I maybe I'll take advantage of that at a future date with you. Thank you again for joining us on the Raise and Exit podcast.
Edgar, thanks. It's been a pleasure to be here. I greatly appreciate it.
You're welcome.